So small businesses we've been talking to across the country over this past year, they often share this concern about access to capital, right? That maybe banks sometimes don't have the right, aren't the right vehicle for them. Can you share a bit about private credit? We talked about this the last time we were on stage, but talk about what it is, because I think sometimes not everybody necessarily kind of understands that.
Right. So at the American Investment Council, we represent about 2/3 of all the private credit assets out in America. And the way a private credit fund works, it's very similar to private equity. We get resources from pension funds, sovereign wealth funds, endowments, and we invest those over, maybe a 10-year period. And we invest largely in small businesses. I think the average size of a firm getting private credit capital is about 150 employees. And what we saw is growth in this post Dodd-Frank, when the regulators and the legislators decided that they didn't want the banks to take as much risk. So it created an environment where you had to go outside of the normal accesses to capital to get it. And that's what we do is we provide a lot of these businesses that may be too risky for a bank to take on. We provide them capital. And I think it's a good reminder. I think the congressman sort of reiterated this, is that we have to be very careful on the regulatory regime. There's even a more onerous, Basel III regulatory regime that will require more capital on banks. That's just going to force more lending outside of the banking system and make it harder for businesses to access capital. And that's not what we need to grow our economy.